Hello and welcome to Moneycontrol. I'm Kaizad Adajania and I'm in Hong Kong over here with Dr. Sonal Desai. She's the Chief Investment Officer of Franklin Templeton Fixed Income. And Sonal, by the way, was one of the few fund managers who stuck a neck out last year, stressing the fact that US Fed is not going to cut interest rates so fast. And Sonal, your prediction has come true. So, what is your expectation from the US Fed? I mean, we know that just less than 24 hours ago, US Fed has kept the rates steady. But how soon would the US Fed now start reducing the rates? Or do you still feel high rates are here for a longer period of time?
Thanks so much for having me on. I would say that at this point, unsurprisingly, I am less out of sync with markets in terms of the number of rate hikes. I do think that the Fed on balance may be one more. It really is very data dependent from this point onwards. However, in terms of rate cuts, as of this morning, markets are pricing in over 80 basis points of rate cuts next year, starting already from June. And I think that is actually relatively unlikely. I don't think we're going to get that many rate cuts. I don't think it starts in June. My expectation is for a single rate cut beginning at the end of the year. Now, many things can change this. You could have a massive external event. You would need to get serious recession for the Fed to cut and validate the market's 80 basis points rate cut expectations.
So you're again going against the market
a little bit, quite a bit. Well, not as much as last year. By the way, it wasn't last year. It's been 2 years that we've been calling for this.
Okay.
So yeah.
So what are the 2-3 big signals that the Fed is going to look at when it decides to finally cut interest rates?
It's likely to be looking at, as are we, one element is wages. The direct inflation numbers obviously are important as well. But more than wages and just the inflation, I think they're going to be looking at the overall strength of the labor market, which one tends to forget, but at between 3.5 and 3.8, US unemployment is still at close to a 40-year low. So this is a very important factor that the Fed is going to be looking at.
But the impact of high interest rates, Sonal, hasn't yet trickled down to the common man and woman. Can you explain in layman's terms as to what's really been happening?
So I think one of the factors is in the US the typical avenue through which interest rate hikes impact consumers in the US tends to be via mortgages. Now the reality is, if I look at mortgages in the US, they're fixed for 30 years. Most people's mortgages were taken out when interest rates were lower. Today, mortgage rates are 8%, but 99% of people have fixed rate mortgages, number one. More than 85% of them have mortgage rates which are less than 3.5%. This means that they actually do not directly get touched by these higher interest rates. And then on top of this, apart from the monetary policy aspect, there is the fiscal policy aspect, where since COVID, we have had extremely easy fiscal policy in the US. And this in turn has led to consumers actually being flush with cash. They remain so. So lots of money to spend, and inflation keeps bubbling up.
And the refinancing also, people have been refinancing.
Oh yes, I was going to say that in terms of refinancing, going back to the mortgage question, what over the last many years, as mortgage rates have come down, it is easy for US residential mortgage holders to go to the bank and essentially refinance their mortgage at a lower rate. Now today, of course, nobody is doing that. The impact of this is that the housing market is frozen. If you have a house and you got your mortgage at less than 3%, why would you go out and buy a different house, because you would now have to take an 8% mortgage? So essentially, housing market is frozen, but that doesn't mean it is in stress because of the higher rates.
What are fixed income investors in US are doing at the moment? I mean, are they finding opportunities outside the traditional avenues when the rates or yields are so high?
So yes, outside traditional avenues, absolutely. But keep in mind, until now, US investors have largely stayed very short in duration, which has been the right thing to do. They have made healthy returns, essentially holding cash or cash-like low duration funds. Now going forward, I think over the next 3 months, 6 months, it is a good time to increase duration, start taking investment grade risk, start taking mortgages onto the portfolio, start taking traditional traditional fixed income, because now we are finally getting to a stage where perhaps fixed income will once again play its role as something that delivers income. It's 15 years that we haven't seen income coming from fixed income in the US.
Sure. And speaking from an emerging markets point of view, with interest rates in the US being high, do you think there could be a risk of flight of capital from emerging markets investing back into US markets?
To some extent. I think it is undeniable that you will see the issue of yield differential playing a role, and you will see some emerging markets paying the price for that. Now again, between market and market, there are huge differences, fundamentals count a lot. There are many emerging markets which are very well positioned for higher US rates. I look at Mexico, Brazil, India for completely different reasons. There are many healthy emerging markets, and there are markets which will face a lot of difficulties and are doing so right now. Turkey, for example.
Okay. Couple of more questions on India, Sonal. India bonds have been included in the JP Morgan bond index. What are the the big takeaways or the big repercussions or the big pointers that can come out because of this move?
I think it's very positive, clearly. Up till now, in the bonds available for purchase by foreign investors, this led to flows of about $12 billion. This should go to $24 billion as the JP Morgan index builds up to full strength. And this is it's a positive thing. And I think that having India included in these indices really is something which is coming at a time where, for a whole series of different reasons, India is really coming up to take its place in a global way. From a financial perspective, there is the fact that from China, right now, people are looking for a new partner. India offers itself as a really exceptional partner in dealing with the West when it's looking for a new space for manufacturing. All these reasons, India is exactly right, and this happened today. And it comes at a point where we've had 7-8 years of massive infrastructure ramp up, so we've doubled the size of our highways and airports and basic infrastructure. All of this is happening at the same time that foreign investors can now look to India and will be able to invest even ever greater amounts into it. So it's a very positive.
It's a positive step.
Yeah.
And as far as interest rates are concerned in India, India's central bank also takes a lot of cues from the Fed interest rates, and our interest rates also have been quite high. What is the strategy that you would recommend for a fixed income investor at this point in time? I mean, is it time for us to shift from short-term debt to long-term debt, or should we still hold short-term debt funds for a little
slowly,
bit longer?
as we look at what's happening in the Indian markets, I think we believe that the RBI is probably pretty much done with its hiking cycle, and also it isn't for the same reasons. It's always a good time to look at extending that duration. But in the case of India, again, we do need to look at what's happening to fiscal policy, and to make sure that on the fiscal front, we don't see too many excesses.
Yeah. Thank you so
Thank
much
you
for
very
talking,
much.
and thank you for watching. For more news, views and updates, keep logging on to moneycontrol.com for more.